Hello everyone, welcome to Commerce Logic. Today we are going to discuss about TCS and TDS forms and e-filing of returns. Now let's move into the topic.
Now we are studying tax collected at source. Tax collected at source by a seller. We say TCS. It's nothing but tax collected at source because the seller is collecting the tax from the customer. We say TCS, that is tax collected at source. In that there are five cases. Case 1 is different, 2, 3, 4, 5 are different in with regarding to tax collected at source. Now let's study about first one, that is case 1. Sale of, if you see in particulars, these are all the different things if you are selling. That means if the seller sells these following things, then he needs to collect, these are the percentages of tax collected at source. See, case 1, it is a sale of alcoholic liquor for human consumption. If the seller sells an alcoholic liquor for human consumption, it is not for resale, it's only for consumption, then he needs to collect 1% of TCS. Then, second one, Indian made foreign liquor. If you sell, that means if a seller sells this Indian made foreign liquor, then he needs to collect 1% TCS on that. Then 10 leaves, 5% is the TDS. Next, timber obtained under forest lease, it is 2.5%. Then timber obtained by any mode other than under forest lease. Forest with forest lease is 2.5% and other than forest lease is also 2.5%. If you observe this, you can find it here. Then any other produce not being timber or tendu leaves. Not if any other things if you produce and sell other than timber and tendu leaves, then 2.5% is the TCS. Then scrap. If you sell scrap, then 1% you need to collect what? TCS. As we are studying, the topic for the day is tax collected at source. Minerals being coal or iron ore, then it is also 1%. Next, it is case 2, grant of lease or license of. That means if there is a grant of parking lot, toll plaza, mining, quarrying, then TCS rate will be 2%. And the condition mentioned here, parking lot, toll plaza, mining and quarrying. Other than, that means except the things mentioned in the bracket. Other than mining and quarrying of mineral oil, petroleum and natural gas. Except these things, if you grant license or lease for mentioned things like parking lot, toll plaza, mining and quarrying is 2%. Then now case 3. What is this case 3? Sale of motor vehicle of value rupees 10 lakhs is TCS at the rate 1%. See, if you sell any motor vehicle for value more than 10 lakhs, that means the sale value of a motor vehicle is more than 10 lakhs, then TCS will be 1%. It's case 4. It deals with authorized dealer for remittance out of India and seller of an overseas store program package from buyer shall at the time of amount debiting by buyer. Here the sentence is saying that seller is a foreign country then and buyer is from India. In certain case, what is the percentage of TCS we need to follow? The following are the things mentioned. Tour packages overseas greater than 7 lakhs, then TCS will be 5%. If education loan is 7 lakhs and more, then 0.5% of TCS. Then TCS at the rate 10% if no PAN or Aadhaar is furnished. Then case 5. Now let's study what is this. A seller who receives consideration for sale of any goods greater than value of 50 lakhs, then TCS is 0.1%. Then what are the due dates for issue of TDS certificates? Now let's study in it. Form 16. The due date for this Form 16 is 31st May of the next financial year in which tax is deducted. Then Form 16A. Within 15 days from the due date of furnishing the statement of tax deducted under Rule 31A. Then here, quarter ended. These will be the quarter ending dates and on which date and month you need to pay this TDS. If you pay, opposite fellow will be collecting the tax. For you, it is TDS, and for the opposite party, it is TCS. Right? Then, if the quarter is ending on 30th June, then you need to pay the tax on 15th August. Then, if the quarter is ending on 30th September, then you need to, that means the due date for this is 15th November. Then 31st December, if the quarter is ending, then the payment of TDS will be 15th February. Then if the quarter is ending 31st March, then the due date will be 15th June. Now next, Form 16B. Within 15 days from the due date of furnishing the challan cum statement in Form 26QB. Then TDS forms. Now let us study what are the different TDS forms. See, here there is a clear visibility of different TDS forms. Form 24Q it deals with a statement of tax deducted at source from salaries. Then Form 26Q statement for tax deducted at source on all payments except salaries. Form 27Q a statement for deduction of tax from interest and dividend. Next, Form 27EQ a statement of collection of tax at source. Form 26QB deposited within a period of 30 days. Now, these are the different dates for TDS returns. Quarter ending and the due date for form number 24Q and 26Q is same, and 27Q and 27EQ is different. And this slide shows the quarter ending, month, and what are the due dates of submission of TDS returns for different forms, that is 24Q, 26Q, 27Q and 27EQ. Now, quarter ended. If the quarter is ending April to June, then the due date for 24Q and 26Q is 31st July. And Form 27Q, the due date will be 31st July and 27EQ is 15th July. Then, if the quarter is ending from July to September, then the due date is 31st October. And Form 27Q is also 31st October. Then Form 27EQ is 15th October. Then, October to December, the due date of 24Q and 26Q is 31st January. And Form 27Q 31st January, 27EQ 15th January. Then, if the quarter is ending from January to March, then the due date for 24Q and 26Q is 31st May. Then, the due date for form number 27Q is 31st May and form number EQ is 15th May. Now, we'll see a new concept called advance tax. The name itself is saying that payment of tax in advance. It is an obligatory for an assessee to pay an advance where the tax is payable is rupees 10,000. If the tax payable is 10,000, then Now, it's a different concept from TDS returns and filing, that is advance tax. What is advance tax? That means we are paying advance. We should pay advance. If you pay tax in early, then it is called as advance tax. Here we are going to study a definition of advance tax. It is obligatory for an assessee to pay advance tax where the advance tax payable is 10,000. That means every assessee is liable of paying of 10,000 rupees as an advance tax. Then due dates for advance tax. Now let's study what are the due dates for advance tax. These are the due dates and other column represents particulars. If on or before June 15th of the previous year, then up to 15% of the advance tax is due. You can pay up to 15% of your total tax of your total tax. Then on or before September 15 of the previous year, then up to 45% of the advance tax is reduced by the amount paid in earlier installments. Then next, on or before 15th December of the previous year, up to 75% of the advance tax is reduced by an amount paid in earlier installments. Next, on or before March 15th, then up to 100% of advance tax is reduced by the amount paid in earlier installments. Then returns. First, return on income. The section of return on income is 139 subsection 1. It deals with compulsory filing of income tax return about assets located outside India. If their assets are locating outside India, then also it is compulsory. There should be a compulsory filing of income tax return about your assets. Then now let us study about e-filing of return. It is a legal obligation for every person whose total income of the previous year exceeds the exemption limit provided under IT Act 1961. We know this is a known concept that every SSC, every person who has to pay the tax, if his income exceeds the limit, then these are the different ITRs and particulars. That means ITR 1, income tax return from 1 to 7. Different form, that means 1 to 7. 1 deals with individuals having income from salaries. It is also called as Sahaj. Then ITR 2, it deals with individuals who does not have income from salaries. We can remember easily. 1, the persons who depends on salaries. Then you can remember in this way, it is called as Sahaj. Normally people depends upon salaries. Most of the people, we can assume, if you assume in that way, then it will be easy for you to remember. ITR, it is also called Sahaj, that means who depends on salaries. Then ITR 2, individuals who does not have income from salaries. First one is salaries and second one is not from salaries. Then ITR 3, individuals and in Hindu undivided families have income under the head profits and gains of business or profession. Then ITR 4, for individuals, HUFs have an income of rupees 50 lakhs, Sugam. Then ITR 5, can be used by companies other than individuals, HUFs, companies and persons filing Form ITR 7. Then ITR 6, can be used by companies other than companies claiming exemption under section 11. ITR 7, can be used by persons including companies required to furnish under section 139 subsection 4A. Then belated return, a section of this is sec 139 subsection 4. What does this belated return? It means simply filing of an income tax return after the due date or extended due date. That means if you file an income tax return after the due date, then we say simply belated return. As we wish to many friends like belated wishes, belated birthday greetings, belated greetings. Same way here also. Then there are other returns like return on income of charitable trust and institutions, return on income of political party, return on income of specified association, revised return and defective returns. These are the various types of other returns, and sections are also mentioned in front of different returns. Here, international taxation. In general, we know about international taxation. Uh, it is a study or determination of tax on a person or a business subject to tax laws of different countries or international aspects of an individual country's tax laws as the case may be. See, we are staying in India and we are earning income in India. So we are paying tax on our income in India itself. If not like that, if you are a citizen of some other country, then you are earning income in some other country itself, then you need to pay income tax as per the country which you are staying. So it depends on the residential status whether you are staying in our country or foreign country, and whether your business exists in home country or foreign country, and it also depends upon whether your assets are held in home country and whether your residential status, that means whether you are staying in foreign country. So uh, taxation depends upon your residential status, whether it might be your income or your personal income or your residential status or where the assets belong to you. So, international taxation depends upon various countries' taxation procedures and that impact on the persons who are earning income in different countries. Now, tax haven DTAA transfer pricing. In this international taxation, these are three different concepts we are going to study. Now let's see what is tax haven. Tax haven is nothing but it's a place where there is no tax on income or the income is low taxed. Then a person or a corporate entity. Tax may be levied on a person as well as a company. So it might be a person or it might be a corporate entity, that means a company where you can benefit. Then moves from higher jurisdiction area to lower jurisdiction area. If it moves from high to low jurisdiction area, then your tax will be reduced. Then we'll see what are the factors of tax haven. These are the various factors of tax haven: nil tax rate, nominal tax rate, then no exchange of information, lack of transparency, limited regulatory supervision, prohibits strict compliance with local laws. There are separate set of rules and regulations for this tax haven areas. Only you need to follow those things. Now we'll say about subpart F. This is a special category of foreign source unearned income that is currently taxed by the Internal Revenue Code 1986. It's mainly a foreign personal holding company income. Then, double taxation relief. Under this, Section 90, agreements with foreign countries and specified territories. 90A deals with agreement between specified association for double taxation relief. That double taxation relief is nothing but you are not going to pay tax in uh, both the ways. You are not going to pay the tax two times. For example, if you are staying in India and your business also exists in India as well as uh, foreign country, then in that case you are going to enter an agreement with the foreign country to avoid this double taxation, you are going to pay tax only in one country, either in your home country or foreign country. To avoid that double taxation, you are entering into such agreements with foreign countries or with specified associations to get in order to get relief from double taxation. Now, DTAA. What is this DTAA? This income is taxed only in one country. Double taxation avoidable agreements. The full form of DTAA is that one. Next, income is exempt in both the countries. That means in both the countries you are not paying the tax. Income is taxed in both the countries, but credit for tax paid is only one country is against the tax payable in another country. That means you are going to pay tax only in one country. Transfer pricing. What is the transfer pricing? It refers to price of the goods used in transferring from one place to another place. It avoids revenue division. That means price of the goods will affect while transferring from one place to another place. And what is its importance? It helps in making correct pricing of products. It helps in evaluating the performance. It also helps in complying with statutory legislation. Then, that's all for today. Thank you for watching. Please like, share, and subscribe the channel. Thank you so much for watching.